In this presentation, we're going to work a practice problem in Excel where we have one company that's going to be creating a fully owned subsidiary. Get ready to account with advanced financial accounting. Here we are in Excel in our practice problem. We've got the information on the left-hand side. We're going to be recording that information into the blue area on the right-hand side and then posting that information into our trial balance. So if we go back to the left-hand side over here, we have the information saying P creates an S. So P created S, so P is going to be the parent. S is going to be the company this time that is being created now, a 100% owned subsidiary. So now we're back to a situation where we're not purchasing another company at this point in time. One company, it's kind of like restructuring, creating another company, breaking off of one company, the parent company, and then breaking off this new company that's going to be the subsidiary company in this example. So P transfers existing assets and liabilities to S, and then in exchange for S shares of $37,006 par. So now in this case, of course, S doesn't have anything before. They're going to be a newly created entity. So remember, this is a type of situation where you're always going to be comparing these two things out. Like you'll see, okay, we have the book value and we have the fair value. In this case, there's not a purchase going on. It's not a market transaction where there's not two parties doing negotiation. When there's two parties doing negotiation, you would typically think that it would be kind of like a sale and that would be fair value. But in this case, they're just basically restructuring. There is no other company until it was brought into existence by the one company who is now the parent company of the subsidiary company. In that case, then, given the fact that there is no actual sale that takes place, it's just basically a restructure type of system, then we want to be using the book value. So you're always going to be comparing these things, and if you look at different kind of book problems, they'll typically give you different types of things to look at in terms of which numbers to be pulling from. The cost, the book value, the fair value. Oftentimes you're considering between these two. If it's a sale type of transaction, then an acquisition of some kind, then typically you'll be looking more at the fair value oftentimes because it's more like a sale. If it's a restructure or some new entity that is being created as a subsidiary from the parent, then you're typically going to be using the book value because there is no market transaction to really tell us, things like what the goodwill would be and things like that. All right, so here we go then. We're going to be recording the transaction for this both with regards to P and then the new company so we can see what this thing will look like on both sides. So we made up basically the beginning trial balance over here just so we can see something that is in balance, and then we're going to be posting our transaction first to P. Once again, I would construct this not in terms of debits on top and credits on the bottom, but in terms of what makes the most sense. And then if you want to go back in and put the debits on top and the credits on bottom, maybe a good idea if it's for a paper or something like that, because some depends how picky your software is or how picky your your instructor is in terms of the format of the journal entry. But in creating the journal entry and going back and looking back at it, I think it's best to format a long journal entry in a way that makes most sense to you, both for practical purposes for making it, and also when you go back and review it in the future, if you constructed it in such a way that that's how your mind works, that it fits together, then you maybe better understand it than having a confusing, debits on. Okay, so here we go. We're going to say that cash is going to be going out. So we're going to say cash. So let's say cash here first. And cash is going from P to S, so it's going to be a credit. We're going to be decreasing cash. I'm going to say negative. Now I'm going to be picking up the book value column, although, of course, cash is the same for every column because the book value and the fair value and the cost would be the same for cash. And then we're going to go to the other assets, and that's going to be, we transferred other assets to the subsidiary. So we, the parent company, transferred other assets to the subsidiary that we're making here, and we're going to be picking that up at the book value. Notice this is kind of like an easier thing to do, right? This kind of reformatting is an easier thing to do because we're not required to revalue all of our books to the fair value in order to make this thing happen here. So then we're going to be going, all right, now let's take the land. So the land, we transferred land. And once again, we're going to be taking, so we're going to pick up the land. I'm going to say land is going to be the 66, and then we're going to pick up the building. Now, there's a bit of a trick to the building here, and this is a little bit tricky because notice they didn't give us, we don't have building and the accumulated depreciation. We're basically saying this is going to be the cost and then the book value, right? And the book value for something like the building or depreciable assets means the cost minus the accumulated depreciation. That's a bit of a tricky question, and you might just you might just be picking up this number, and then you might be thinking in your mind, hey, there's no accumulated depreciation like there typically would be for building and equipment. And so hopefully that might be something that kind of triggers you, like, well, that means something's going on here. And then why did they give me this cost line? Because usually I'm comparing book value and fair value. Well, it's because the cost line is how you're going to be figuring out the amount of the book value, which is the accumulated depreciation. So it's a bit of a tricky kind of scenario there. So but luckily we're sharp here. Mind is focused, and we pick that up. So we're going to be picking up, all right, the building then we're going to be putting on at cost, right? At cost, and then we're going to pick up the accumulated depreciation. And if you have the trial balance over here, then you can see it too. Like if I'm over here and saying, okay, wait a second, we transferred some of the building, there's got to be accumulated depreciation. In practice, that would be very obvious. In a book problem where they don't give you the trial balance over here and they just give you a set of numbers, and then it becomes much more ambiguous, right? That's why I really think it's helpful to think about these types of problems and then actually post them to a trial balance, even if you have a good visualization of what's going on here, because I think it really solidifies things a lot better. So in any case, we're going to say then we've got the accumulated depreciation, which is going to be the difference between the cost and the book value. So the difference between the cost and the book value must be the accumulated depreciation. It's going to be a debit because it's a contra asset account. And we can see here on the trial balance, got a credit balance here. So we're going to make it go down by doing the opposite thing to it, which is a debit. Okay, so let's go back on over. We're now going to say that we have the equipment, same kind of thing. It's a depreciable asset. Therefore, I'm going to be putting it on the books for the cost, picking up the cost. And then we're going to pick up the accumulated depreciation related to that, and I've abbreviated ACC Depre. ACC Depre. I just like the sound of it too, so I abbreviate it there instead of accumulated ACC Depre. So then we're going to be saying the cost minus the book value. There it is. Okay, so then we have the accounts payable. Let's pick up the accounts payable here, if we may. Now, the accounts payable is a credit balance account. We need it to go down. Therefore, we're going to debit it. So we're going to debit the accounts payable because it's a liability and we want it to go down. We're going to be picking up the book value for the accounts payable, even though they're all the same over here, right? They're all the same because, it represents money we owe. So that's quite possible, but it could possibly be different and time to time. And so the difference here that we need, the plug, is going to be the $337,000. So in other words, we're transferring out net assets. So you can see basically the net assets here. We have assets, and these are contra accounts, and then the liability, the net assets that we're transferring, not the net assets of P company in total, because that's the equity section or retained earnings in this case. We're transferring the net assets, which will be the net assets that will be represented in S company when we create it, that will be shown in the equity section. So the equity section then for S company will equal that $337,000 because it represents assets minus liabilities, which are all coming directly from the parent company right now, which is the equity section. Equity section also representing what is owed to the owners of the company. Who owns company S? It's fully owned by P, and therefore this whole equity section is going to tie out to that 337 net assets that have been put into it. On P's side of things, we're going to record this as the investment in S. So investment in S represents these net assets that have now been transferred out to S, and we're gonna decrease these net assets, all these accounts, and we're gonna put them into and represent them in one line item, one asset account, investments in S, which will tie out to the equity section that will result in company S once we record the transaction there. All right, so let's do this. We're going to do that with our plug formula, which is the negative sum. So negative sum of these items. All right, and then let's go ahead and post this out. So we have our beginning trial balance, and this is what we transferred out from it. So I'm going to say, all right, for cash, we credited out $33,000 out of the parent company, leaving us with $67,000, and then for the other assets, we credited out $72,000, leaving us with $248,000. Then for the land, we're going to credit out the $66,000, leaving us with $466,000. For the building, we're going to credit out the $181,000, leaving us with $302,000. For the then we have the building. This is the accumulated depreciation, which has a credit balance. It will then be going down to the 96,000. Then we have the equipment, which is going to go down by 96,000 to 147,000 minus, and then we're going to say the accumulated depreciation is going to go down by the 22 to the 52,000. And then we got the accounts payable, which is going to go down, and so it has a credit balance, so we're going to debit it to make it go down to the 180,000. The difference going into our asset account, which is going to be the 337,000. So this account goes up, and all these other basically net assets are going to go down, and now we're representing them with just one line item. Now let's record the same thing on S. So what happens on S's side of things, the new company that's being created? Well, same kind of thing. We're going to say, all right, well, now we've got cash is going up for S. We're going to say cash is going up for S. And well, let's pick up the amount. That means it's going to be a debit for S. We're going to be picking, now you might want to pick it up. You can pick it up from either side. You can almost mirror. It might be easier to actually mirror. You can pick it up over here again, or you can kind of mirror the transaction up here. In other words, this was a credit, it's going to be a debit down here. I'm going to pick it up from the transaction over here because a book problem might give you this information and ask you for P's journal entry or S's journal entry with just this information. It's nice to see both sides because that's a kind of a double check that you have reconciled, because you'll note that this amount here will tie out to the equity section in S. So doing the whole problem actually is easier in some cases. But in any case, we're going to say, all right, S is going to get 33,000. So we're picking up the book value here, book value, because it's a newly formed entity that was not in existence before. No market transaction, just basically a restructure. We're going to debit the 72,000 to it for the other assets. We're going to then put in the land. Land is going up for here by the 66,000. The building is going up, and here's where that tricky thing is, same tricky thing. The building, they didn't give us the accumulated depreciation, but rather the cost and the book value. Therefore, the building is going to go up by the cost that's being transferred. And then we're going to have the ACC Depre representing accumulated depreciation, credit balance, contra asset, which is going to be, or let's do it this way. I'm just going to say equals, and I'm going to say the little number minus the big number. The little number, which is going to be the book value minus the cost, will give me a negative or credit of the 32,000. And then we're going to say that we want the equipment, same kind of thing, same kind of little tricky business here happening. They're put a little curveball there, but we're going to be picking up the the cost this time. And then the ACC Depre, accumulated depreciation, is what that represents. That's going to be on the credit side of things. And once again, I'm going to take the little number minus the big number, which is going to be the book value minus the cost, which will give us that negative accumulated depreciation of the 22,000. So obviously, you know, if I highlight these two, the book value is the 149, the 149. If I highlight these two, the book value is the 74, the 74. Then accounts payable is going to go on the books this time. Accounts payable is going on the books. Accounts payable is a liability account this time, or it always is. So that means over here then, it needs to be on the credit side of things. So we're going to credit it for the 57,000. Okay, same scenario here. If I was to say, all right, I put everything in that new company that I need to do, I'm going to have a difference of the 337,000, which matches the same difference I had up here. Same and opposite, except it's a credit this time. But I'm not going to put it into investment in P. No, that's not what happens down here. We put it into the equity section. So what happens is the S corporation, or not the S corporation, the corporation that the subsidiary corporation is transferring their stock from the subsidiary corporation in exchange, right, for this. So therefore, we're going to put it into the equity section. So the plug's going to go into the equity section. However, the issuance of stock has that added little twist where we often have the common stock at a par value, and the par value has no actual, tying to market value. It's just like a placeholder. So we got to figure out the par value and then put the difference into the additional paid in capital. So in other words, we're going to take that same 337,000, We're going to figure out the par value, and then the 337,000 minus whatever the par value is will be what goes into additional paid in capital, so that the amount in both of these accounts basically represents that 337,000. Okay, so let's do that. We're going to say we've got the common stock that we're going to issue, and I'm going to say negative, so it represents a negative number here, and we're going to be picking up then the 37,000 shares that were issued times $6 par. $6 par. And there we have it. That's the 222. And then the additional paid in capital then is the difference between, what was transferred, the assets that were brought in, which was the 337,000 minus the 222,000, which again, if we just highlight the entire thing, is now 115. So that's our plug. That's our plug formula. So negative sum of that, and that's going to give us our 115. And of course, these two numbers now represent the 337,000 that's going to go into the blue equity section here, which is represented on P, parents' books, by the investment in P, the 337,000. Let's record it out, check it out. So we had nothing here before because this is a new, fresh, new entity that has been created. We just created it with nothing. We made this thing out of nowhere. It's amazing. So it's going to be the 66. We're going to pull over the building. And then we've got the accumulated depreciation, the equipment. We'll pick up the equipment. The accumulated depreciation related to the equipment, or the ACC depre equipment, and then the accounts payable, and then the common stock, and then the additional paid in capital, and there we have it. So that puts us back in balance down here. So now end of the day, this amount right here in the equity section represents that 337,000. And if you think about that, of course, what did we transfer in? We transferred these assets minus that liability, and that's what's in there, the 337,000, which represents the equity section, the book value of the company being the equity section. Equity section represents the book value of what is owned and by the owners. So what is basically owned to the owners is kind of like a liability, except instead of owed to a third party, it's owed to the owners of the organization. Assets minus liability owed to the owners. Who's the owner? Well, that's going to be S company up here, or P company up here is the owner. And so how does P company represent this? One line item here showing that same 337,000 on the one line item on P's books.